Consumer journalist Wendy Knowler joins me now. Wendy, hi. I'm wondering, is it time to fix the bond rate, and what exactly does it entail?
Okay, so that's quite a natural thing to want to do because, we're being hit with this interest rate. We'll start seeing the emails coming from our credit providers saying your installment will go up to whatever. But obviously, it's a risk game, so the bank wants to mitigate its risk as well. So you could apply for it on your home loan, for example, and obviously it will go up because when you took out the loan, had chosen the fixed rate, you would have been on a higher interest rate. Incidentally, I did that on a car once, about 9 years ago, and for the whole 5-year duration of the term, all the interest rate did from that point is go down. So I paid a higher one to start off with. It was a huge fail and very embarrassing. So there is that risk. But yes, if you ask for it to be fixed now, it will be fixed for anything from 2 to 5 years, and obviously the interest rate will then immediately go up. So you will then be hoping that the further increases that you wouldn't have had to pay will offset that. But at the end of that period, 5-year maximum, 2 to 5 years, you then have to renegotiate because it's only fixed for that amount of time, depending on what the bank wants to fix it for. And then your personal circumstances might have changed, and maybe the interest rate that they're now willing to give you would be higher than if you'd stuck with the original one. So it's not without its risks. And some banks just won't do it. When I took out a loan at the end of when property was booming suddenly after lockdown, end of 2020, there was no option from the bank I chose anyway to fix the loan at that point.
Of course, you're reminding me, Wendy, and I'd forgotten this, because at the point that you take out your bond, all the banks want your business, and that is the time to negotiate. So you can try and get prime less half a percentage point, or prime less half a percentage, or prime less 1, and whatever you get, you're paying slightly less than the general lending rate. But I didn't know that if you fix your rate, they're perfectly within their rights to go to the standard rate and not keep the benefits that you might have negotiated at the beginning of your bond contract. That's a really interesting point. We do know that the cycle is on the upward swing. So we've had 2 increases now, and there could be quite a couple more. But I suppose you have to look at that versus the reality that they're probably going to add 1.5% percentage points more to fix you, because it's on their interest to fix you at this low rate, knowing it's going to go up. So you would have to another bump.
Initially.
Yeah.
Yes. So it's a big gamble. As I say, I played that game once and I lost out quite magnificently. So I'm a little bit fixed interest rate shy. But I think for the other risk, as I say, that you have to consider is what happens when that fixed. The interest rate is not fixed for the full remaining term of your bond, for example. So you might be in a worse position at the end of that fixed period when you're now renegotiating. Yeah.
So, Wendy, we also know, so the interest rates are starting to creep up. We also know that Eskom has asked the energy regulator for a 20.5% increase in our electricity tariffs. If they get anywhere close to that, even if they don't, it's going to have a knock-on effect on absolutely everything. So we are moving into an increasingly difficult time financially. What is the right mindset as we contemplate this reality? And are there any practical things that we could be doing now to protect ourselves, cushion ourselves?
Okay, so I always feel sounds a bit trite when we talk about, tightening your belt and doing all the right things, and people listening thinking, lady, I tightened my belt long ago, this ain't going to help. But there are always things we can do, little things, a whole lot of little things do add up to financial relief. So first of all, go through your bank statement. A lot of us don't really want to come face to face with those numbers, but that's the first thing you have to do, because first of all, I can tell you now from my experience in dealing with consumers' issues, there are many, many debit orders that people are paying routinely every month that they shouldn't be paying. It's for an old cell phone insurance, for example, or something they've forgotten about. And then negotiate your insurance premiums. A lot of people want to cut them, but trust me, from my side of things, not having insurance is a very, very expensive, very risky option. But if you've been with one company for a long time, it's called a loyalty penalty. I can assure you your premium will be much higher than it should be. So that's one way of cutting down monthly expenses. What you want to do is save on all those things that you're routinely paying, that you contracted in, that you have to pay, and then put those savings not into rewarding yourself by going out for dinner, but into paying off, bringing down your debt, because our debt is becoming more and more expensive. So what you want to do is reduce what you owe across the board, so that you make those, so that you're paying less every month to service your debt. The figures that we South Africans pay, I don't have them top of mind, but to service our debt every month are absolutely horrendously high.
All right, so it's like going through all our accounts with a fine-tooth comb. Thank you very much. Consumer journalist Wendy Knowler. Certainly issues that we have to consider. Every penny counts, of course.